How to invest in stocks for beginners. Fast, Rish 1. Hey everyone, welcome back to the channel. If you're new here, I'm Zetroder Clout Channel, and today we're diving into how to invest in stocks for beginners, fast and with a focus on managing risks. If you've ever wanted to start investing but felt overwhelmed, this video is for you. Let's get started. What is stock investing? 2. Stock investing means buying shares of companies, making you a partial owner. As the company grows, so does your investment. But there's also risk. Prices can go up or down based on various factors. 3. The goal of investing is to grow your money over time, and historically, the stock market has been one of the best ways to do that. But how do you start? Let's break it down step by step. Step 1. Understand your goals. 4. First, identify why you want to invest. Are you saving for retirement, financial independence, or just looking to grow extra cash? Your goals will determine your strategy and risk tolerance. 5. If you have a short-term goal, like buying a car in 2 years, stocks may not be the best option due to volatility. But if you're investing for the long term, stocks can be a great choice. 6. Long-term investing allows you to take advantage of compound growth, where your earnings generate more earnings over time. 7. Additionally, setting clear financial goals will help you stay disciplined and not make impulsive decisions based on short-term market movements. Step 2. Learn about risk. 8. Investing always involves risk. The higher the potential return, the higher the risk. Understanding this will help you make smarter decisions. 9. Some stocks are safer than others. Large, established companies, blue-chip stocks, are more stable, while small startups can be high risk but offer higher rewards. 10. Market risks, economic downturns, and company-specific risks can impact stock prices. Always assess risk before investing. 11. One way to manage risk is by diversifying across different industries and asset types. Step 3. Choose a brokerage account. To start investing, you need a brokerage account. Platforms like Robinhood, E-Trade, Fidelity, or TD Ameritrade allow you to buy and sell stocks easily. Compare fees, ease of use, and available tools before choosing a brokerage. Some offer commission-free trading, which is great for beginners. Consider whether you want a traditional brokerage, a robo-advisor, or an app-based investing platform. Each has its pros and cons. A good brokerage should provide educational resources and research tools to help you make informed decisions. Step 4. Learn stock market basics. Stocks trade on exchanges like the NYSE and NASDAQ. Prices fluctuate based on supply and demand, company performance, and market trends. Understanding key terms like market capitalization, dividends, and price-to-earnings (PE) ratio will help you analyze stocks better. Stocks can be classified into growth stocks, value stocks, and dividend stocks, each with different investment characteristics. Keep an eye on economic indicators like interest rates and inflation as they influence stock prices. Step 5. Diversify your portfolio. Don't put all your money into one stock. Diversification reduces risk. Invest in different sectors like technology, healthcare, and consumer goods. Exchange-traded funds, ETFs, and index funds are great options for beginners since they provide instant diversification with minimal effort. Consider diversifying across asset classes such as stocks, bonds, and real estate to further reduce risk. Keep a balanced portfolio that aligns with your risk tolerance and investment timeline. Step 6. Start small. You don't need thousands of dollars to start. Many platforms allow fractional investing, meaning you can buy small portions of expensive stocks like Amazon or Tesla. Start with an amount you're comfortable losing. Even 50 or 100 is enough to begin your investing journey. Small investments over time can add up. This strategy, known as dollar cost averaging, helps reduce the impact of market volatility. Regularly investing a fixed amount can help you develop disciplined saving habits. Step 7. Analyze stocks before buying. Before investing, research the company. Check their earnings reports, revenue growth, and industry trends. Use tools like Yahoo Finance, Bloomberg, or your brokerage platform to study historical performance and expert analyses. Look at a company's competitive advantage, leadership, and financial health before making a decision. Avoid investing in stocks based on hype or social media trends without proper research. Step 8. Invest for the long term. Successful investors focus on long-term growth. Short-term trading can be risky and requires advanced knowledge. Historically, the stock market grows over time, so patience is key. The longer you stay invested, the better your chances of earning solid returns. Avoid the temptation to time the market, as even experts struggle to predict short-term price movements. Stick to a well-thought-out investment plan and review your portfolio periodically. Final tips and recap. To sum up, set your goals, understand risks, pick a brokerage, diversify, start small, research stocks, invest for the long term, manage emotions, reinvest earnings, and avoid common mistakes. The key to successful investing is patience, discipline, and continuous learning. Markets fluctuate, but those who stay consistent tend to win in the long run. Always stay informed about market trends, economic events, and financial news to make better investment choices. Keep learning, refining your strategies, and adapting as you gain experience in the stock market. That's it for today's video. If you found this helpful, hit the like button, subscribe for more investing content, and drop your questions in the comments. Thanks for watching, and I'll see you in the next video.